Right now, at this exact moment, something is happening in the silver market. Not next year, not next quarter, right now, and almost nobody is paying attention. Silver today is trading roughly in the $25 to $30 per ounce range in global markets. That number looks normal. It sounds normal. It feels like nothing special. But that's exactly why this matters. Because the most important market shifts never feel important at the beginning. They feel quiet, they feel boring, they feel easy to ignore, until suddenly they're not. And by the time people realize what's happening, the move is already gone. So let me say this clearly. What's happening in silver right now is not just a price move, it's a repricing event. And those two things are completely different. A price move is temporary. A repricing event changes how the market values an asset entirely. And when that shift happens, everything after it accelerates faster, stronger, more aggressively than most people expect. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. Now, here's the first layer most people see, the chart. Because if you look at silver over the last few years, it tells a story. In 2020, during the global crisis, silver dropped below $12 per ounce. Within months, it surged past $25, more than doubling. Then it stalled. Then it moved sideways. Then it surged again. And recently, it's been fluctuating between roughly $22 and $30. And this is where 95% of people make the same mistake. They look at that chart and they simplify it. They assume silver isn't moving anymore, or it already had its run. But that interpretation misses what's actually happening underneath, because what looks like sideways movement is often accumulation, positioning, preparation. And if you understand how commodities actually move, you realize something important. The biggest moves almost always come after long periods of quiet. Now, here's where we go deeper, because silver doesn't move randomly. It follows a pattern that has repeated across decades. And that pattern starts with gold. Gold moves first, always. When uncertainty rises, inflation fears increase, or currencies weaken, institutional money flows into gold, because gold is the primary safe haven. It's liquid, it's global, it's trusted, so naturally, it gets the first wave of capital, and that's exactly what we've seen. Gold has been trading near record levels, recently pushing toward the $2,300 to $2,500 range per ounce in global markets. That's a massive move compared to where it was just a few years ago. Now here's what happens next. As gold rises, silver initially lags behind, and that creates a gap measured by something called the gold to silver ratio. This ratio tells you how many ounces of silver it takes to equal 1 ounce of gold. Historically, this ratio has averaged between 40 and 60, but in recent years, it has often been higher, sometimes 70, sometimes even 80. And when that ratio stretches, it signals imbalance, because silver is relatively undervalued compared to gold, and that imbalance doesn't last forever. It corrects. And when it corrects, it doesn't happen slowly. It happens fast. This is exactly what we saw in 2011. Silver went from around $18 to nearly $50 in less than a year. That's not a normal move. That's a repricing. Now here's the key insight. If gold stays elevated and the ratio compresses back toward historical norms, silver doesn't just move slightly. It reprices higher. And that's not speculation. That's arithmetic. Now let's layer in what's happening right now, because this is where the story becomes real. Institutional positioning. While most retail investors are watching headlines, institutions are watching flows, allocations, positioning shifts, and what we're seeing is subtle but important. Silver ETF holdings have been fluctuating, but long-term interest remains intact. Central banks are buying gold heavily, and historically, that leads to increased attention towards silver later in the cycle. Now combine that with something even more powerful, supply, because this is where silver becomes very different from gold. Gold mostly sits. It's stored, preserved, accumulated. Silver is consumed, used, destroyed in the process. Electronics, medical devices, solar panels, electric vehicles, semiconductors, all of these rely on silver, and not in small amounts. Now here's the key problem. Global silver supply has been relatively flat. Annual production sits around 800 to 850 million ounces, but demand, it has been rising. And in some recent years, total demand has exceeded supply. That creates a deficit, and deficits in commodities don't disappear. They accumulate year after year, and eventually they force price adjustments. Now here's where things accelerate, because silver demand is not just growing, it's transforming. Solar energy alone has become one of the biggest drivers. Each solar panel requires silver, and as countries push toward renewable energy, solar installations are increasing rapidly. According to industry estimates, solar demand alone accounts for a significant portion of total silver consumption, and that demand is projected to grow, not shrink. Now add electric vehicles. EVs use more silver than traditional cars. Add AI infrastructure, data centers, high-performance chips. All of these rely on conductive materials, and silver is one of the best. So now you have rising industrial demand, flatter constrained supply, and increasing strategic importance. And this is where the narrative shifts, because silver is no longer just a precious metal. It's a hybrid asset, part monetary, part industrial, and that combination is powerful, because it means silver benefits from economic uncertainty and technological growth. Now step back and look at the full picture. Gold is elevated. The ratio is still above historical averages. Demand is increasing, supply is constrained, institutions are positioning, and yet yet silver still feels quiet, still feels normal, still feels undervalued. And that disconnect is where the opportunity exists. Because markets don't move based on truth alone, they move based on perception. And right now, perception hasn't caught up yet. Most people are still looking at silver like it's 2015 or 2018 or even 2020. They're looking at the chart, not the structure. They're reacting to past movement, not future positioning. And that gap between what is happening and what people think is happening is where the repricing begins. But here's the catch. This doesn't move in a straight line. It never does. And this is where most investors fail. Because before a major move, markets test conviction. They shake out weak hands. They create doubt. They create volatility. And that's exactly what we're seeing. Short-term fluctuations masking long-term shifts. Now here's where things get even more interesting. Because what's happening underneath this market right now, it's not just about price. It's about structure, flows, and positioning. And once you see that layer, you start understanding something most people miss. This isn't the end of a move. It's the setup for the next one. And that next phase is what 95% of people will completely miss. And this is where things stop being just interesting and start becoming serious. Because what's happening underneath the silver market right now is not visible on a simple price chart. It's happening in data, in flows, in institutional positioning. And if you don't look there, you miss the entire story. So let's go one layer deeper. Because the first thing you need to understand is this. The silver market is not just driven by retail investors. It's driven by institutions, banks, funds, commodity desks, and these players don't react to headlines. They react to structure. And right now, the structure is shifting. Let's start with demand, because this is where the imbalance becomes very clear. Global silver demand has been hovering close to, or even exceeding, 1 billion ounces annually in recent years. At the same time, mine supply has struggled to keep up. Annual production is roughly 800 and 150 million ounces. That gap, that's not small. That's a structural deficit. And this isn't a one-time event. It has been happening repeatedly, which means something very important. The market is consuming more silver than it is producing. Now think about what that actually means, because this is not like stocks, where supply can increase quickly. Mining takes time, years, sometimes decades. You can't just flip a switch and produce more silver, which means when demand rises, supply doesn't immediately respond, and that creates pressure. Pressure that builds quietly until it doesn't anymore. Now here's where demand becomes even more powerful, because it's not just growing, it's accelerating. Let's talk about solar, because this is one of the biggest drivers. Each solar panel uses silver in its photovoltaic cells, and globally, solar installations are expanding rapidly. Governments are investing billions into renewable energy, countries are setting aggressive targets, and companies are scaling production. Now here's the key detail. This demand is not optional. It's policy-driven, which means it continues regardless of short-term market conditions. Now add electric vehicles. EVs require more silver than traditional cars. Why? Because of electrical systems, battery management, sensors, connectivity. Now layer in something even bigger, AI infrastructure, data centers, high-performance computing. All of these require advanced electronics, and advanced electronics require conductive materials. And silver is one of the best conductors on the planet. So now you have three massive demand drivers: energy transition, transportation shift, technological expansion, all pulling on the same resource at the same time. Now let's contrast that with supply, because this is where the imbalance becomes undeniable. Global silver production has not significantly increased over the last decade. In fact, in some periods, it has declined. Mining companies face challenges, rising costs, environmental regulations, geopolitical risks, declining ore grades, which means extracting silver is becoming harder, not easier. So demand is rising, supply is constrained, and the gap is widening. Now here's the critical point. Markets don't ignore gaps forever. They resolve them. And in commodities, resolution comes through price. Now let's bring in institutional perspective, because this is where things get even more interesting. Major financial institutions track these imbalances closely. And while their public statements are often cautious, their positioning tells a different story, because institutional investors don't wait for confirmation. They position before it. Now here's something important. Silver ETFs and funds have seen fluctuating flows, but long-term interest has not disappeared. In fact, during periods of uncertainty, allocations tend to increase, because silver acts as both a hedge and a growth-linked commodity. Now let's talk about something most people overlook, the correction, because this is where the biggest misunderstanding happens. When silver pulls back, most investors assume the move is over, but that's not how cycles work. Corrections are part of the process. In fact, they're necessary, because they remove excess speculation, they shake out weak hands, they reset positioning, and they create the foundation for the next move. Now here's the pattern. In previous cycles, silver has experienced sharp pullbacks before making even stronger moves upward. 2008, silver dropped significantly during the financial crisis, then rallied aggressively over the next few years. 2020, silver crashed during the initial panic, then surged rapidly within months, and this pattern repeats, because the underlying drivers don't disappear during corrections, they remain. Now, let's connect this to what's happening right now, because the current market environment is unique. Interest rates remain elevated compared to recent years, inflation concerns are still present, economic uncertainty is increasing, and central banks are navigating a difficult position. Now here's why this matters. Because silver reacts to multiple macro forces. If inflation persists, silver benefits as a hedge. If growth slows, monetary easing becomes more likely, which supports metals. If the dollar weakens, silver typically rises. So in multiple scenarios, silver has tailwinds. Now this doesn't mean it moves instantly or in a straight line, but it does mean something important. The structure supports higher pricing over time. Now let's talk about psychology, because this is where most investors fail, not because they lack information, but because they misinterpret it. When markets are quiet, people lose interest. When markets are volatile, people lose confidence. And when markets correct, people assume it's over. But smart investors think differently. They look at structure, not just price. They focus on positioning, not headlines. They understand that the best opportunities often don't feel obvious in the moment. Now here's where this becomes critical, because the silver market right now is in that exact phase. Not the hype phase, not the panic phase, the setup phase. The phase where demand is rising, supply is constrained, institutions are positioning, but public attention is still low. And historically, this phase doesn't last forever, because eventually the market catches up. And when it does, the move accelerates. Now here's the risk, because this is not a guaranteed path. Markets can remain volatile. They can overshoot. They can correct further. And that's what creates uncertainty. But uncertainty is also what creates opportunity, because if everything were obvious, there would be no edge. Now step back and look at everything together. Silver is trading in a relatively moderate range. Demand is increasing across multiple sectors. Supply is constrained. Institutional interest remains. Historical patterns suggest strong moves after consolidation. And macro conditions are supportive. This is not random. This is a setup. And setups lead to moves, but only if you recognize them early. Now here's where things shift again, because understanding the data is only part of the equation. The real difference comes from how you interpret it, because the final phase of this story is not about silver. It's about how investors think and why most people miss moves like this completely. And once you understand that, you don't just see this opportunity, you start seeing others like it. And that's where everything changes. Because up to this point, we've been talking about silver, the data, the structure, the imbalance between supply and demand. But the real reason 95% of people will miss this move has nothing to do with silver itself. It has everything to do with how people think, because markets don't just move based on fundamentals. They move based on behavior, and most investors follow the same patterns. They wait for confirmation. They wait for headlines. They wait until something feels obvious. And by the time it feels obvious, it's already too late. Think about it. When silver was below $15, nobody was talking about it. When it crossed $20, some people noticed. When it moved higher, interest started building. And when it eventually becomes a headline again, that's when the majority will enter. Not at the beginning, not during the setup, but during the visibility phase. And that's the phase where the easy gains are already gone. This is the cycle, over and over again. Early phase, ignored. Middle phase, doubted. Late phase, chased. And most people only participate in the last one. Now here's the difference. Institutional investors don't wait for visibility. They operate in the early and middle phases. They look at data, positioning, flows, and they build exposure gradually before the crowd arrives, because they understand something simple. The best opportunities? Now, here's another layer most people miss. Narrative, because markets are driven by stories. And right now, the dominant stories are elsewhere. Artificial intelligence, tech stocks, economic uncertainty, interest rates. That's where attention is, and attention drives capital. But here's what happens. Narratives shift, slowly at first, then suddenly. And when they do, capital follows. We've seen this before in commodities, in energy, in metals, and asset goes from ignored to discussed to dominant. And when that transition happens, the price doesn't just move, it accelerates. Now here's the critical point. By the time silver becomes a mainstream narrative again, it will already be significantly higher, because the move happens before the story spreads, not after. Now let's talk about risk, because this is important. Understanding a setup does not eliminate uncertainty. Silver can still be volatile. It can pull back. It can move sideways. It can test patience. And that's exactly what it does before major moves, because volatility serves a purpose. It removes weak hands. It forces emotional decisions. It creates doubt. And that doubt prevents most people from holding long enough to benefit. This is why timing becomes so difficult. Now here's where the psychology shift happens. Average investors try to predict exact moves, exact tops, exact bottoms. Smart investors focus on positioning. They don't need to be perfect. They need to be early enough and disciplined enough to stay in the game. Now think about everything we've covered. Silver is trading in a moderate range. Demand is increasing across multiple sectors. Supply is constrained. Institutional positioning is building. Historical patterns support strong moves after consolidation. And yet, most people are still on the sidelines, waiting, watching, hesitating. And that hesitation is the reason they miss it, because markets reward action based on understanding, not reaction based on headlines. Now, here's the final piece, because this is where everything comes together. Repricing events don't announce themselves. They don't come with clear signals. They don't tell you when they start, after they've already happened. And that's the paradox. The moment of maximum opportunity is also the moment of maximum uncertainty. And most people choose certainty, which means they sacrifice opportunity. If silver moves from where it is today to significantly higher levels over the next few years, most people will say, I saw that coming, but they didn't act. Or they'll say, I wish I had paid attention, but they didn't understand. And a small percentage will say nothing because they were already positioned before it became obvious. And that's the difference. Not intelligence, not access, not luck, understanding. Now, I want you to think about this. When you look at silver today, do you see a quiet market or do you see a setup? Because how you answer that question determines how you act next. And that decision is what separates people who watch opportunities from people who capture them. So here's the question. Do you think silver is still being overlooked? Or do you think the move has already started? Drop your thoughts in the comments. And don't just say yes or no. Explain your reasoning, because the real value is not just in the answer, it's in how you think about it. And if you want to, understand markets at this level, not just what is moving, but why it's moving. Make sure you subscribe.